welcome to this very brief session on finance. My name is Siddharth Dani. Just to give you a brief introduction, I come with about 20 years of experience, having worked in large organizations, especially in the area of strategy, corporate finance, and investor relations. There was a time in 2006 when I had founded a company in the financial services space, and we were successfully able to exit the company. By qualifications, I'm a chartered financial analyst, and I've also got a management program from IIM Lucknow. Just to give you a broad idea about the agenda of this particular session. Finance as a field is broadly split into two. On the one hand, you've got the field of accounting, bookkeeping, and anything that is to do with record keeping of finances is all one side of and one part of finance. And on the other side, you've got a lot of forward-looking elements, which include projections. There is investment management. Where do you invest your money? If there are a lot of companies that raise capital, so fundraising both on the equity side, on the debt side, it all falls on as part of finance. So finance is while we have only this one word used, which is finance, finance is actually split into two. There's accounts and there is finance. I think in order to get a good hold of finances as far as a business is concerned, it is really very important to understand the basics of accounts, because accounting really forms the foundation on which finance is actually built. So today what we will be doing is we'll be talking a little bit about accounts, and as part of a business, as a founder of a business, I think it is very important to know that what are the basic financial statements that a business typically generates. Generally, what we see in most organizations is that there are typically three types of financial statements. You have the profit and loss account, there's a balance sheet, and there's a cash flow statement. Most companies really focus only on the first two, which is your profit and loss and the balance sheet. But as good practices, there's also the cash flow statement that is also built. I think what we will be focusing on today is just getting a basic understanding about these three financial statements, and I will try to make it as simple as possible for your understanding, and then we can probably have some more elements that I could talk about in subsequent sessions. So let's start with the first one. Before that, just to give you an idea in terms of why finance is important. I think that any business, one of the most important aspects of any business is to generate money, to generate profits. So understanding finance and understanding how to manage finances is very important. And it's one of the most important aspects that any founder or any entrepreneur should be well versed with in order to build and grow a successful business. So what is the amount of investment that is required in starting a business, in running a business, and therefore based on the investment, what is the kind of returns that can be generated? This understanding and this clarity of understanding is very important in running and growing a business. There are times when businesses require a lot of funds, and this really happens usually at the initial stages of a business, there is a lot of investment that goes. Only when the investment is made can some value be delivered to a customer. And when there's value that is delivered to a customer, will the customer pay for those for the value that they get? That is when the business actually starts making money. Um, Therefore, the initial stage of the business where investments are required, there is also the need to raise funds. And it is very important to know and understand as to what is the exact amount of funds that would be required before the business actually starts generating cash flows and can sustainably continue running going forward. Like I mentioned earlier, there is also the element of um, ensuring that investments that will be generating returns going forward, those investments need to be deployed in the best possible manner. Um, Managing your working capital so as to bring about the most optimum investments in your business is also one of the aspects of finance, and that's another area why finance is important to understand. I think as businesses uh, kind of grow, and and if you see some of the most successful businesses that are there today, one of the most important aspect about the founder or the entrepreneur is that they have been able to monitor the progress of their business uh, on a periodic basis. And if there is no monitoring, there is a very high risk in terms of either the business running out of money or the business ending up in a lot of debt. And that is a situation that needs to be avoided. For that, continuous monitoring should happen. Uh, it could be on a weekly basis or it could be on a monthly basis, but monitoring the progress is important, for which we need to also understand finance and the basics of finance. All of this eventually gets stitched down to this, that how do you see the future? How can you effectively predict what is the scenario in which the markets are going to be, the customers are going to behave, and therefore how it is going to impact your finances. So, planning and taking into consideration all the future elements, um, and being ready so that there are no surprises as we go along is again a very important aspect. And all of this eventually boils down to understanding finance and understanding the basics of accounting. So let's get going. I'll be focusing on, in this particular session, I'll be focusing only on the basics of financial statements. The financial statements form the basis towards building and understanding the whole of finance. And it's very important to have this this basic understanding, which creates the foundation for anything to do with finance. So we'll start with the first financial statement. So broadly, I mean, before that, there are, like I mentioned earlier, there are three financial statements. You've got the profit and loss statement, the balance sheet, and the cash flow, and we'll talk about each one of them as we go along. So let's get down to understanding the profit and loss statement. This is by far one of the most important financial statements that any business owner typically looks at. Just to give you a broad definition about the P&L statement, it's basically a record of your business's profits and losses over a defined period of time. Period of time can be defined as at the discretion of the founder. So a founder may choose to look at his P&L statement either on a daily basis, or he could look at it on a weekly basis or a monthly basis. what we see for listed companies and large enterprises is that a P&L statement is reported on a quarterly basis, and uh, uh, it's one of, like I mentioned, it's one of the most important statements that reflects the true performance of a business. The second bullet point that I'm showing on the screen is going to be one of the most important messages for today's session. And this statement will give you an idea in terms of how you can differentiate a particular expense or an income, and categorize it under either a profit and loss statement or a balance sheet or a cash flow statement, right? So the statement reads that the income and expenses, the benefit of which does not exceed a particular year. Now here I'm just defining a period as a year, but the period can be either a day, a month, whatever is defined by the particular founder. So the benefit of which does not exceed that particular period is typically classified under the P&L statement, right? Let me just give you a simple analogy, and let me try to relate this to your personal finances. Let's say that you are out of college and you move to a new city, you get a new job, you take a new house on rent, you make some friends in the city, and your office is not too far away, so you decide to commute by bus, by the local bus, or you decide to take an Ola or a Uber. Um, Typically, the way your personal finances P&L account would look like is that you will have your income, which is your salary, and then from your salary, you will be deducting all your expenses like your rent, your travel expenses, your food expenses. There could be some entertainment expenses, and not to mention there will also be some outflow cash, some cash outflow that relates to your tax, right? What you are left with at the end of the day or end of the month, and let's assume that you are left with some amount. That amount is typically what we call as savings, right? But in business parlance, your savings is nothing but your profits for the business, right? Um, the P&L statement of a business looks very similar to this. Let us see how the typical format of a P&L statement looks like. It's pretty self-explanatory. So nevertheless, I'll still go and talk about each of the line items. The first item is your sales. This is the income that is generated from customers once the goods or services are delivered. This is the amount that the customers pay to a business, right? And that is recorded under sales. Moving on to the next item, your cost of goods. This is nothing but if you take an example of a manufacturing unit, let's take an example of a car manufacturing company. The raw materials that the company procures in order to assemble a car is the expenses that typically get recorded under the cost of goods. So any expenses that are related towards delivering a product or a service by a business is recorded under the cost category or under the line item cost of goods. Once this expense is deducted from the sales, what you are left with is the gross profit, and this is the first element of profit that a business sees. And profits are expressed in different ways. You've got the gross profit, you've got the operating profit, and you've got the profit after tax. So what differentiates each of these profit items is what I'll is what I will mention now. That once the expenses are borne and the payments are made to all the external vendors for helping the company in delivering the sales of the goods or services, and what the amount that is effectively retained by the business is categorized as gross profits. Now, your gross profits are the first level of profits that the company sees, because it's from these profits that it can actually start making expenses for its internal resources. The internal resources are what? You will have your employees, you will have maybe an office, you've got expenses associated with the offices, and any other expenses that the company or any other resource that the company employs at its discretion is what is paid through the gross profits. Depreciation is one element which is very common in all the profit and loss statements. It is nothing but the consumption of a particular asset during that particular period. Going back to our personal finance example, let's say that you decide on not commuting by Ola or Uber, but you decide to buy your own vehicle. And let's assume that you procure and you purchase a car, a Maruti car. Um, let's assume that the life of the Maruti car is 3 years, after which the car has to be disposed of. The benefit of using that car will be actually spread out over uh, each of the months of the 3 years, right? So if let's say the cost of the car is 5 lakhs, um, what you will be actually consuming during a month will be nothing but 1 divided by 36, right? Multiplied by 5 lakhs. This is what we typically categorize and classify under the item, which is depreciation. So depreciation is nothing but consumption of a particular fixed asset during that particular period, right? And depreciation is something that you will see in typically most of the P&L statements. So coming back to the profit items, the next most important profit item is your operating profits. This is the profits that a business generates after paying off all the expenses towards running his businesses, right? What comes after the operating profit is the cost element, which is your financing and interest cost, which is the interest that is paid on the funds that the business generates. Now, diverting a little bit, typically there are two types of funds that any business uses. One is your equity fund, and the other is your debt fund. Your equity fund is nothing but the funds that the promoter or the founder invests in the business, which is his own funds, right? Your the other type of fund is your debt fund, which is nothing but the loans that the business raises through either a bank or an NBFC. Now, the equity funds typically don't have a cost element to it, though there is a cost attached to it, but there is no real cash outflow that the founder has to bear on a periodic basis. Loans, as we are all aware, there is an interest element which has to be paid as per the defined periodic payment terms. And this is the cost that is typically recorded under the interest item, right? Uh, After this, you have the tax element, which we all have to pay to the government. There's a tax expense. And then what you're actually left with is your profit after tax. Your profit after tax for any business, if you relate it to the personal finance analogy, is nothing but the savings that you generate at the end of the month. This is the amount of funds that any business has for, and it can be used as per the founder's discretion. So the founder may decide to take these funds back into his personal account, or he may decide to use these funds to invest in a new business. So it's completely as per his discretion, and it's not necessary that these funds need to be deployed back into the business. It's as per the founder's choice. So this is a brief about a profit and loss account statement. We will move on to balance sheet. Balance sheet is the next very important statement for any business. And the one of the most important differences that differentiates a balance sheet with a profit and loss statement is that A balance sheet is nothing but a statement which is recorded at any one single point in time, right? How it differentiates with the P&L statement is that P&L is recorded over a period of time, whereas a balance sheet is recorded at the end of that period. So if you take a financial year, which is typically from 1st of April to the following March end, your P&L is recording all the transactions that have happened during the period of 12 months from April to March, whereas a balance sheet is nothing but the financial snapshot of a company at any single point in time. Now, let me move back to the personal analogy example. Let's say we talked about the fact that you have already purchased a vehicle of your own. Let's say that you decide to invest from your personal savings, you decide to invest in a new flat for yourself. So while your P&L is clear, what you will record in your balance sheet is nothing but the assets that you own at the end of the period. That period end can be the end of the month, it could be end of the year, like we talked about earlier. But these are the assets that you typically own. Now, these assets can be, in this particular example, the house that you will own, the car that you will own, and then also there could be some savings that you already have. Maybe you had invested in some FD, you may have invested in some mutual funds. Uh, what is the total value of those investments? That will also get reflected in your balance sheet. If there is also a home loan that you've taken or there's a vehicle loan that you've taken, that loan will also get reflected. So a balance sheet is nothing but uh, the assets and the liabilities that you have at the end of a particular period, right? Typically, your assets and liabilities have to match. There is if you just take a simple example of the home loan and the flat that you buy, if you are buying a flat of worth 100 rupees and you take a loan of 80 rupees, the balance 20 rupees is typically coming from your own savings, right? And so your 20 rupees of savings, 80 rupees of loan on the liability side matches with the 100 which is on the asset side, which is the value of your flat. Coming back to a business balance sheet, this is a typical format of how a business's balance sheet looks like. There you've got the assets on one side, you've got the liabilities on the other side. I will quickly go through each of these items, and I hope that it would give you a good sense about how a balance sheet is structured. So starting from the liability side, you've got your net worth to begin with. Your net worth is nothing but all the initial capital that you had invested in the business, along with all the savings that you've generated or the profit after tax that the business has generated over a period of time. Both these put together is the net worth of the business. Followed by the net worth is all the bank loans that you take. So without getting into the details of or the terminology of these items, uh, convertible debt, long-term bank loan, these are nothing but debt that a business takes, based on which there is an interest payment that the business has to make. All of that falls below your net worth, and it sits here under your total long-term liabilities. What follows the long-term liabilities is your current liabilities, and this is typically to give you an example, you will have your vendor who you decide to procure some raw materials from or procure some services from, and you tell the vendor that you're not able to pay immediately, but you will pay them after a month or maybe after 2 months. So what is that amount which is due to your vendors? It typically falls under accounts payable. Similarly, if there are any other liabilities that the business owes to external parties, gets reflected in other current liabilities. So all of this put together forms your liabilities side of the balance sheet. On the asset side, again, the structure is very similar. You've got a long-term asset that is placed on the top side, followed by your current assets. Your long-term assets are those assets such as building, plant and machinery, computers maybe, any fixed assets that the business procures falls under your gross assets. We talked about depreciation, so the value of the asset diminishes over time. In the case of your personal finance example, your flat that you procure will typically never depreciate over time because real estate always appreciates. So for a flat there will be no depreciation, but the vehicle that you have procured that depreciates over time. What you buy today, if we assume that you buy the vehicle for 5 lakhs, but it is not that when you sell the vehicle after 3 years you're going to get your 5 lakhs back, right? What you will get is probably just 50,000. I'm just taking that as an example. The 4.5 lakhs is what you has is the value that is depreciated over time. So that is typically deducted from the asset value to get the next net fixed asset value of the assets that you own. Under current assets, what you typically have is what is the cash that is there in the bank. You may have some inventories lying. There could be scenarios where your customer has told you, just like you've told your vendors, that they will pay you after 30 days or 45 days. So what is the amount that you are expected to receive from your customers falls under the accounts receivables part. And then similarly, there could be any other section or any other income that you are expected to get that would fall under your other current assets. So all of this put together forms your asset section of the balance sheet. And typically, your assets and liabilities will eventually match. So this is an overview about your balance sheet. Moving on to your cash flow statement. Your cash flow statement as compared to a balance sheet or a P&L account is very simple to understand. It's nothing but your actual cash inflows against your actual cash outflows. So it's just about taking a bank statement, moving to your personal finance example. If you just look at your bank statement and assuming that you've made all your payments from your bank account, if you just look at your bank statement, your bank statement is nothing but is what reflects as your cash flow statement. So what is the actual cash that has flown in and what is the actual cash that has flown out, right? In terms of your salary, for example, like most companies have this concept of cost to company, where there is a gross salary and there's a net salary. Your gross salary is what is offered to you, but the company typically deducts your tax at source. So what you are actually paid is a percentage of your gross salary. What will reflect in your bank statement is nothing but your net salary. So if you're drawing, let's say 1 lakh a month, you will actually get the amount that you actually get in hand would probably be only about 70,000 or 80,000 rupees. That is your cash inflow. And this is that amount that typically goes and sits in your cash flow statement. Similarly, for businesses, it's nothing but the cash inflows and outflows during the year. It can be, it's again at the discretion of the management or the founder to look at the cash flow statement. They may want to look at it on a monthly basis, quarterly basis, yearly basis. And just moving to the broad format template of the cash flow statement, this is how it typically looks like. It's broadly categorized into three sections. You've got cash flow from operations, cash flow from investing, and cash flow from financing. So these are the three broad sections. Cash flow from operations are nothing but cash flows that relate to running the business, running the operations of the business. Cash flow from investing could be all investing decisions that the company takes. It could be in long-term assets. It could be in parking your funds in bank FD or mutual funds, etc. And these are all investing activities. And financing activities are nothing but fundraisers. So you raise a loan from the bank or you raise equity capital from investors, the funds that flow into your business typically get categorized under cash flow from financing. This is typically how the entire, so you've got different elements to it. Without getting into the details of it, I think what is important to understand at this point is that there are three sections, which is your operations, investing activities, and financing activities. And this is the typical format for a cash flow statement. So, having covered broadly the three financial statements, I hope you've got a good sense, in at least a broad sense, in terms of what are the financial statements, and at a very broad level, how the three financial statements differ. The next piece of item which I would like to cover is this concept of free cash flow. And this is a concept which is very important in finance, and it's used quite widely, not only in accounts, but also going forward in terms of managing your finances, fundraisers, etc. This is one parameter of any business that is looked at very closely by all investors, founders, etc. And I would like to just touch upon typically what a free cash flow typically is. So, just to give a definition to free cash flow, it's nothing but the fact that businesses need to make investments in order to kind of thrive and grow. The cash flows that are typically left with after all the operating expenses are taken care of, and the business or the founder continues to invest in future growth of the business, typically which is categorized under your capital expenditures. After this amount has been deducted from your net profits, is what is actually left for the business or for the founder, which is at his discretion. Let's take an example again for of the auto company that we talked about, right? Now, we understand what profit after tax is for a business. It's equivalent to the savings that the business generates at the end of the period. As far as the company is concerned, unless the company reinvests in future new car models or future maybe manufacturing facilities, it cannot really grow on a regular basis, and therefore the business has to keep investing in building new car models, designing new cars, investing in new technologies, such that tomorrow it can offer something better to the customers, and the customers can keep coming back to the business and paying the business, right? So this investment typically is what is deducted from your savings or from the profit after tax. And that is whatever is left after that is truly the free cash flow, is a cash flow that is free, that can be used for any purpose that the business requires or the founder may want. In simple calculative terms, it is nothing but the cash flow from operating activities minus your capital expenditures. These are the expenditures. So going back to, let's say, your personal finance example, what we saw was the savings that you generated at the end of the month, every month. If from the savings you are deducting even your home loan expense or your vehicle expenses, these are the expenses that are very important for you to continue holding that property or holding that vehicle, right? Such that you can, over a period of time, that becomes yours. These are the expenses that you typically, this is an expense that you are ready for and you're willing to give first priority towards for making a payment towards. After deducting these expenses, what you are actually left with at the end of it is your true free savings. And these are the savings that then you can do whatever you want with it. You may consider going for a vacation. You may consider, going, investing the money in a mutual fund or whatever you want. It's completely as per your discretion. So that is a concept that is used for free cash flow. Again, this is the formula that is used for calculating the free cash flow for any business. It starts with you taking your profit after tax. Typically, all the non-cash elements are added back, and depreciation is one item that typically gets added back to your profit after tax, such that you are left with your true cash flows. That the business is actually generating. From the cash flow from operations, your capital expenditure are deducted in order to arrive at the free cash flow that the firm generates for itself. So, a very important financial parameter that is used by most businesses, um, that is used by investors, founders, entrepreneurs, and ensuring that you are always free cash flow positive is one of the most important goal that any founder should focus on. I think that's a very important point that I wanted to bring about in this session, and introduce you to this concept of free cash flow. So that was an overview about financial statements. We covered the profit and loss account statement. We talked about balance sheet, and we talked about the cash flow statement. And besides that, we also got introduced to this concept of free cash flow, which is a very important financial parameter for measuring the success of any business. With that, I would like to conclude with this final slide in terms of uh, some of the important aspects to consider uh, for for any founder as far as his business is concerned. Uh, the first is that, um, and it's really very prudent and a very good practice, is to measure, if you are running your own business. It's a good practice to measure your cash flows on a daily basis. So what is the amount that is coming in and what is the amount that is going out? That will really bring about a very strong control in managing your business. Number two is that your cash and your finances are uh, very important, and it's as far as possible, founder should not delegate the spending decisions to any other resource in his organization or his firm. uh, Try to keep all major spending decisions to yourself, because that will help you get better control on the overall finances of the business. Um, it's it's very easy, and it's very tempting to invest very aggressively, and invest a very big amount. We've seen a lot of startups, we've seen a lot of early stage companies that have invested aggressively in the beginning. And there are businesses that have succeeded based on those decisions, but a lot of businesses have also shut down and failed just because they've been very aggressive in their investing decisions. I think the best way to really manage finances is to have a very measured approach towards your cash expenditure decisions. Um, Resources or employees for any business are some of the most important investments that any business makes. Having some of the best people to work for the business is contributes significantly towards the success of the business. So when it comes to hiring for the business, it's one of the most important decisions, and is always good to be careful and follow some of the best practices in hiring. When it comes to any of your financial plans, when it comes to planning your finances for the next 3 months, for the next 6 months, always it's prudent to always maintain a bit of a buffer in all your expenditure plans um, and the cash inflows that you foresee coming in. You never know how things change, and we are in a scenario and a market where um, things change overnight, and so there is a lot of risk that you end up in terms of any additional expenses that may come up going forward. So it's always good to include a buffer in all your financial plans that you eventually uh, prepare for your business. So yes, I think that's about it in terms of the brief content that I wanted to share with you. I hope that this session has been informative and that there is um, uh, a few key elements that you are able to take away from this session. Thank you for a patient listening, and I hope to share a lot more going forward.